Good morning, everyone. The dollar weakened going into Fed Chair Janet Yellen's testimony before the House Financial Services Committee on Tuesday, based on the idea that she was likely to be more dovish than her predecessor, Mr. Bernanke. In the event, Yellen's comments, all 6 hours of them, were almost exactly what Bernanke had been saying. In particular, she said that the Fed will continue to taper off its bond purchases unless there was a noticeable change in the Fed's outlook for growth, employment, or inflation. Her comments may indicate that both the unemployment and inflation thresholds would have to be breached before the FOMC would change rates, or perhaps what she said boils down to, we'll raise rates when we feel like it. In the end, the implied interest rate on the long-dated Fed funds futures rose around 6 basis points, and 10-year bond yields rose also 6 basis points, indicating that Yellen was less dovish than the market had expected. But the S&P 500 was up 1.1%, and the VIX index fell to 14.5 from 15.3, which shows that she was considered to be generally supportive, too. So she really walked the middle way. In the FX market, the safe haven yen and Swiss franc were lower, as was the euro, but the dollar lost ground against the other G10 currencies, most notably the Canadian dollar. Today's feature will be the Bank of England's quarterly inflation report. It's expected to include a new version of the forward guidance that Bank of England Governor Mark Carney put into place with so much fanfare just last August. The problem was that when they put the guidance into place, they said that they didn't expect to hit the unemployment threshold of 7% for 3 years. But it's almost there already. Unemployment's at 7.1%. They can't drop the idea of forward guidance so quickly, but the speed with which the threshold was met and the alacrity with which they're abandoning it means that investors may not believe the bank's commitment to any replacements either. The market expects that they'll replace the single unemployment threshold with a range of indicators of slack in the economy, such as wages, growth, and inflation, to give them more wiggle room. That's really not so much different from the previous system of inflation targeting that they used to have. So the market will also be looking to see what the Bank of England's new inflation forecasts are, as that may now be a more reliable indicator of the likely course of monetary policy. Given that they were near to crossing their previous threshold for tightening policy, any change can only push out the time for tightening, which should, in theory, be negative for the pound. The only question is whether that's already discounted in the market. The market currently is discounting a change in rates sometimes between 2 and 3 years from now, which indicates to me that nobody really believed the forward guidance anyway. As for today's indicators, the only significant one out is the Eurozone industrial production for December. That's estimated to have declined. That could put some downward pressure on Eurodollar. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.